All right, so Chapter 19 of The Intelligent Investor. We're going deep on shareholder activism and dividend policy.
Oh, this is a good one. Graham was tackling some pretty tough questions even back then.
It's wild how relevant it still is, right? Like back in 73, he was already calling shareholder activism a lost cause.
Yeah,
Shareholder lethargy, he called it. Basically, he saw that even when companies weren't performing well, the shareholders, well, they just weren't stepping up to challenge management.
so they'd accepted the status quo.
Yeah.
But remember, this was 1973. The whole idea of individual shareholders banding together to influence corporate decisions, it was still pretty new.
So then what changed things?
Well, you might find this surprising, but it wasn't the shareholders themselves. It was the fear of takeovers.
Ah, takeovers.
Yeah.
So for anyone listening who might not be super familiar with that, it's basically when one company tries to buy up enough shares of another company to gain control.
Right, like a corporate power struggle.
Yeah.
And Graham saw how that fear really lit a fire under underperforming management teams.
A wake-up call to start prioritizing shareholder value.
Exactly. And while hostile takeovers aren't as common these days, that underlying principle of accountability is still key.
Definitely. Companies need to answer to their shareholders. So what mechanisms exist today to make sure that's happening?
Ooh, good question. And it leads us right into Graham's next big point, the whole debate around dividends.
Right. He saw this shift happening, investors moving away from the traditional love of big dividend payouts.
Especially when it came to what he called growth companies. You see, growth companies are all about reinvesting profits to fuel future growth.
So paying out huge dividends, it could actually hurt their potential.
Exactly. Graham used some really compelling examples to illustrate this. Think Texas Instruments.
Didn't their stocks soar in the 50s, even though they weren't paying dividends?
It did. Investors were all in on the long-term potential, happy to skip those immediate payouts.
Betting on future growth instead of just seeking a quick buck. And wasn't there another example? Superior Oil.
Oh yeah, Superior Oil is a classic example. They actually reduced their dividend, and guess what? Stock price kept climbing.
Shows how much investors valued their growth prospects over those immediate cash payouts.
Right. But Graham also made it clear this isn't one size fits all. He contrasted these growth companies with, say, AT&T.
Where dividends were a much bigger part of the equation.
Right. And then there's IBM, which was all about growth, less emphasis on dividends.
And Graham's key point here.
Shareholders deserve a clear explanation when a company chooses to pay a low dividend or no dividend at all.
Is it because they're investing in future growth that will benefit everyone?
Exactly. Or is it because they're in a weaker position and just can't afford to be generous? Transparency is key.
Now, before we go any further, we've got to clear up two terms that often trip people up. Stock dividends and stock splits.
Ah, yes, they sound so similar, but they're totally different beasts.
Let's start with stock dividends. How did Graham explain those?
Think of it as like a bonus. A company gives shareholders a piece of those reinvested earnings, but in the form of more shares.
So instead of cash, you get more stock.
Exactly. And those shares, they represent real value. You can hold on to them, boost your ownership, or sell them for cash, just like with a regular dividend.
Okay, got it. So how's a stock split different?
Imagine you're slicing a pizza. More slices, same amount of pizza, that's a stock split. More shares, but the company's total value stays the same.
So why bother with a stock split then?
To make the stock more accessible. A lower share price can attract more investors, especially smaller ones. Makes it feel more affordable.
Even though the company's worth the same. Makes sense. Now, Graham had some pretty strong feelings about how companies should handle their dividend policy, right?
He did. He wanted a more transparent, systematic approach.
Specifically, he liked the idea of periodic stock dividends.
As a way to capitalize those reinvested earnings, let companies fuel growth, and give shareholders a tangible piece of the pie.
And he contrasted this with what a lot of public utilities were doing back then.
Right, they'd pay cash dividends and then issue new shares to raise capital.
Which Graham saw as more complicated and maybe not so great from a tax perspective.
Potentially leading to double taxation for the shareholders. First on the cash dividends, then again on the new shares if they sold them. Stock dividends, he argued, were just more efficient and fairer.
So already thinking about transparency, shareholder value, tax efficiency, all the way back in the 70s. Amazing.
He was ahead of his time.
Makes you wonder how much has really changed, right?
A great question, and one we'll tackle as we keep going with our deep dive.
But before we jump into part two, let's take a second to reflect on what we've covered so far. What surprised you about Graham's take on shareholder activism and dividend policy? And how does all of this connect with your own investment philosophy? We'll be back in a moment to continue this fascinating discussion.
Welcome back. It's interesting, even Graham, as legendary as he was, admitted that fighting for change as a shareholder could feel like a losing battle.
Yeah, he even used the word quixotic, right?
He did. In Chapter 19, he talks about how powerless individual shareholders often felt at annual meetings.
Like one person trying to steer a giant ship.
Exactly. So, did he think shareholder activism was pointless?
That's a good question.
Not at all. He knew the hurdles, but he never discouraged shareholders from staying informed, from being engaged.
So still stay active, even if your individual impact might be limited?
Right. He believed in the power of collective action.
Strength in numbers.
Exactly. If enough shareholders get behind a common goal, well, then they can really have an influence.
And that idea of unity, it ties into the whole shift in thinking about dividend policy we were talking about.
It does.
Graham saw that investors, especially those interested in growth companies, were okay with smaller dividends, maybe even no dividends, if it meant more growth down the line.
It's that age-old dilemma, immediate reward or long-term potential.
Bird in the hand, two in the bush.
Right. And Graham, he had some great examples to illustrate this.
We talked about Texas Instruments, but wasn't there another one? Superior Oil?
Oh yeah, Superior Oil's a great one. Their stock took off, even when they cut their dividend.
Investors clearly believed in their growth more than those immediate payouts.
Exactly. So no dividend wasn't a bad sign. It meant they were serious about investing in their future.
Putting those profits back into the business to create even more value down the road.
Right, which sometimes is better than just paying dividends.
But Graham wasn't saying dividends are irrelevant, was he?
No, he knew they're important, especially for investors who need that income.
It's all about context, right? Understanding why the company is making the decisions it's making.
Absolutely. Blindly chasing high dividends without understanding the company's strategy, that's dangerous.
So align your goals with the company's dividend strategy.
Exactly. There's no right or wrong answer. What matters is making informed decisions.
And speaking of understanding the details, I think it's time we revisit those two terms that often cause confusion.
Oh, you mean stock dividends and stock splits?
Those are the ones, they sound similar, but they're very different.
They are. Let's start with stock dividends. Graham saw them as a way for companies to give shareholders a real piece of those reinvested earnings.
Without actually selling any of their shares.
Right, it's like a bonus. Lets you share in the growth without spending any extra cash.
And as Graham pointed out, it can be more tax efficient than getting cash dividends and then having to reinvest that money.
You avoid that extra layer of taxation.
Makes sense. So, more shares, bigger ownership stake, and potentially better tax treatment. Now remind me, how does a stock split work again?
Okay, imagine this. You've got pizza, you cut it into more slices, same amount of pizza, just smaller pieces.
That's a stock split. More shares, but the company's value stays the same.
Exactly. Each share just represents a smaller portion.
Okay, so if the value is the same, why would a company do a stock split?
To make the stock more appealing. Lower price attracts more investors, especially smaller ones.
It just feels more affordable even though nothing's really changed.
Right. And Graham, he really pushed for transparency when it came to dividend policy.
Companies should either pay a decent chunk of their earnings as dividends,
Or explain clearly why they're holding on to those profits.
transparency and accountability.
Exactly. Keeping everyone on the same page.
So Graham's ideas have really shaped how companies think about dividend policy.
They have. Of course, there are new things too. Stock buybacks, for example.
Another way to return value to shareholders.
And of course, the huge growth of index funds and passive investing, that's changed things a lot.
That's a big one. With so much of the market held by passive investors who might not be as engaged with the companies they own.
It makes you wonder, what does that mean for shareholder activism going forward?
How do you make your voice heard when so many investors are taking a more hands-off approach?
That's a tough question. It's like what Graham said, fighting for change can feel like an uphill battle, even today.
With all the progress we've made, it's still a challenge.
It is. But it just shows how important it is to stay informed, understand the market, and make decisions that align with your goals.
Be an intelligent investor.
Exactly.
Before we wrap up this deep dive into Chapter 19, let's take a moment to reflect. What surprised you about Graham's insights on shareholder activism and dividend policy? Did any of his observations make you rethink your own approach to investing? We'll be back in a moment to continue this conversation. It's pretty amazing to think Graham was writing about all of this, what, over 50 years ago? And it's still relevant today.
Right. The fight for shareholder rights, the changing role of dividends, it's all still playing out.
Goes to show the power of his insights, critical thinking, understanding what's really driving those corporate decisions. That never gets old.
It doesn't.
And he wasn't afraid to challenge the status quo, even on something as basic as dividends.
He wanted shareholders to be informed, to push for transparency, hold management accountable.
He knew there's no one-size-fits-all answer in investing.
What works for one company, one investor, it might not work for another. You got to understand the details, the context, and then make your decisions based on your own goals, your own risk tolerance.
He really wanted investors to think for themselves.
He did. To be engaged, to understand the businesses they were putting their money into.
This whole chapter, it really drives home how much the investing world is always changing. But those core principles, those stay the same.
They do. Like your North Star, guiding you through the market.
So as you keep reading The Intelligent Investor, as you keep learning and growing as an investor, remember those principles. Don't be afraid to ask the tough questions. Challenge those assumptions. And most importantly, think for yourself. That's what it means to be an intelligent investor, which is what Graham wanted for all of us.
He did, and he gave us plenty to think about.
He sure did. And here's one last thought to ponder as you keep going on your investing journey. Remember how we talked about index funds and passive investing? Well, that's something Graham couldn't have foreseen back in '73. So think about this. How has the rise of passive investing changed the relationship between shareholders and the companies they own? It's a big question. No easy answers. But exploring it, well, that can lead to some really valuable insights into how the market's evolving.
It can. Who knows? You might even uncover some brilliant investment ideas that Graham himself never even imagined.
You might just. Well, that's going to wrap up our deep dive into Chapter 19 of The Intelligent Investor. Hope you enjoyed the exploration as much as I did. Until next time, keep those investing principles sharp, and remember, knowledge is power, especially when it comes to money. Happy investing.